The US borrowing plan for 2024 is insane. Are you ever interested in how a country handles its debt and what happens when it borrows so much that it seems impossible to pay back? There will be no more records for how much the US borrows in 2024. The Treasury plans to borrow more than $1.5 trillion in just the first half of the year. What does it mean for the business and American people that the government is taking on so much debt? Come with us as we look into the important questions that surround this insane plan to borrow money and get into the specifics of it. Are we about to have a financial crisis, or is this a plan to keep the economy stable? Keep listening to find out. There has been a significant amount of discussion on the borrowing plan that the United States Treasury Department has recommended for the year 2024. This is due to the enormity of the project as well as the wider economic ramifications that it may include. It is the purpose of this video to study the specifics of the plan to borrow money, to investigate the factors that lie behind the surface that are driving this approach, and to investigate the potential economic implications that may result from this strategy. In this section, you will provide an overview of the plan for borrowing. The United States Treasury Department has reportedly announced that it intends to borrow a total of $776 billion during the first quarter of the fiscal year 2024 and an additional $816 billion during the second quarter of the same year. This information comes from a source. As a component of a larger effort to control the national debt and deal with repeated budget deficits, these figures demonstrate a significant increase in borrowing when compared to the prior years. Additionally, they are a component of the bigger effort. The reasons that led to the decision to take out a loan are as follows. Several significant concerns, including the following, are the primary motivating factors behind the Treasury's borrowing strategy for the year 2024. There is a deficit that is significantly larger than what was anticipated. Due to the fact that the deficit for the fiscal year 2023 was substantially bigger than what was initially projected, there was an increased demand for borrowing money. Both the private sector and official estimates anticipate deficits of a comparable amount for the year 2024. Balance sheet reduction. The Federal Reserve is allowing United States Treasuries worth $60 billion to roll off its balance sheet each month. This is part of the overall measure of balance sheet reduction. Fresh market issuance is required in order for the Treasury to fulfill this obligation, which is to replenish this money. Demand dynamics for United States Treasuries. The demand for United States Treasuries has fallen among traditional buyers, such as banks and central banks from foreign nations. This is a result of the dynamics of demand. Based on the information provided by Source 8, a number of foreign central banks have liquidated their Treasury holdings in order to safeguard their own currencies as a consequence of the rise of the value of the United States dollar. Uncertainties relating to the economic and geopolitical domains. In addition, the borrowing strategy has been strongly influenced by geopolitical worries and economic uncertainties, such as the pressures of inflation and a rise in interest rates. It has been brought to the attention of the Federal Reserve that there is a possibility that interest rates will remain elevated for significantly longer than previously anticipated. Consideration of the economic context and the implications of this context. It is vital to have a comprehensive awareness of the larger economic context in which this borrowing strategy is being implemented in order to have a complete comprehension of the repercussions that this strategy will have. Rates of interest and rates of income. Inflation. Rates of inflation, and more specifically core inflation metrics, have issued messages that are in conflict with one another. Variability has also been observed in interest rates. Additionally, there have been inconsistencies in the indicators regarding interest rates. During the month of September, there were indications that a reacceleration was occurring, which might be seen as a potential hazard for future inflationary pressures. On the other hand, despite the fact that both core CPI and PCE inflation had a significant slowdown from June to September 2023, there were hints of a reacceleration in September. This deceleration occurred throughout the period of time from June to September 2023. In spite of the fact that wage growth has slowed down, the job market is still experiencing a significant amount of competition. Currently, the labor market is undergoing a number of different conditions, and this represents one of them. With the potential to further complicate issues, there is a possibility that this tightness may result in an increase in labor prices. This may further complicate efforts to bring inflation under control, which may further complicate matters, taking into consideration the ever-evolving nature of the housing market. The current status of the housing market is another area that people are concerned about. Despite this, house prices are once again on the rise as a result of increasing mortgage rates, which are limiting the number of homes that are currently available for purchase. This is causing a decrease in the number of homes that are available today. This has been a contributing factor in the occurrence of disinflation, which has been brought about by a more gradual increase in the prices of housing, which has resulted in a decrease in inflation. The source claims that increasing oil prices and geopolitical threats both provide upside risks for inflation, which further complicates the economic outlook at a time when the economy is already facing a number of challenges. The reactions of the market and the dynamics of the conditions around the yield on the Treasury. The request to borrow money and the greater economic situation have both been met with a range of reactions from the market, which has been perceived as having mixed reactions. Treasury yields have experienced a significant spike as a result of a number of factors, including the following. Higher real yields. The majority of the increase in yields on 10-year Treasury notes can be attributed to higher real yields, which are measured by Treasury inflation-protected securities. The term premium is a word that refers to the more yield that investors may require in order to retain longer-term debt. This higher yield is commonly referred to as a term premium. In addition to the amount of volatility that has been noticed in the market aid source, this has been a factor that has contributed to the increase in Treasury rates. Auction performance. In general, Treasury auctions have been successful in exceeding their allotted bids, which is an indicator that there is still a market for debt issued by the United States of America. However, there have been indicators that demand is falling. One example of this is the reopening of the 30-year bond auction, which resulted in a price that was 3.7 basis points lower than the rate that was prevalent before to the sale. An approach to strategy that is both flexible and issue strategy that allows for flexibility. The Treasury has placed a significant amount of emphasis on the necessity of strategic flexibility in its issuing strategy. This is due to the high level of uncertainty that surrounds the predictions for both the deficit and the economy. There are a number of aspects of the borrowing plan that have been investigated by the Treasury Borrowing Advisory Committee. One of these aspects is the potential benefits that could be obtained by converting the 6-week cash management bill to a benchmark tenor. Not only does this offer additional flexibility, but it also has the potential to offer support for the overall. The plan that the United States of America has to borrow money throughout the year 2024 is an example of a significant and varied endeavor to address the financial challenges that the nation is facing. This idea illustrates the intricate relationship that exists between fiscal policy, market conditions, and broader economic trends. Changing demand dynamics for United States Treasuries, deficits that are larger than projected, and reduction of the balance sheet of the Federal Reserve are the factors that are driving this trend. As the Treasury Department attempts to overcome these challenges, policymakers, investors, and economists alike will be keeping a careful eye on the ramifications that these issues will have for the economy, financial markets, and future actions taken by the government in terms of fiscal policy. It will be vital to maintain a focus on strategic flexibility and market conditions in order to successfully manage the potential risks and uncertainties that are associated with this major borrowing plan. This will be the case in order to ensure that the strategy is effectively managed. Don't miss out on future videos that break down the biggest financial and economic stories affecting you. Hit the subscribe button, ring the notification bell, and stay informed with our expert analysis. Your journey to understanding complex economic issues starts here.